Hi, welcome to Chapter 2. I hope you are enjoying the course so far. I hope you've got McGraw-Hill figured out. We are almost kind of rolling now. We do just need to do one more thing, and that is to make sure that you can do your exams. But in the meantime, why don't we start with Chapter 2? We'll talk about that, and then we'll get in and make sure that you can do your trial exam. So the way that it's Chapter 2, what it's going to do is it's going to kind of dive into what each major type of account is. So you know that there's 5 accounts: assets, liabilities, equity, revenue, and expenses. And you know that they will, there's different sort of sub accounts in each one, but they all have different purpose. They all belong in different financial statements, and they all have different ways that they react to debits and credits. So Chapter 2 will also introduce you to debits and credits. Make sure that you know how to analyze a journal entry and a transaction. One thing that you'll see in your workbook is 6 steps to analyzing transaction. Now that is not really clear in the textbook. It's sort of something that I work through with my students in class, so I'll kind of go through it with you today. So what are the 6 steps of analyzing a transaction? The first is it a transaction? So a transaction, of course, does it have a financial implication on the business? If someone is going on vacation, well, it won't unless you are paying them a wage. That decision is not a transaction. That's a business decision, but it's not a transaction. If you are going to hire somebody new, it's a business decision, but it's not a transaction. If you are going to pay a plumber to fix your toilet, now you've got a transaction that has financial implication. You're paying someone. So that is sort of in a nutshell. Now the textbook will go into details. Not every transaction has to use cash. We need to adjust expenses. Might have impact to the reporting. So definitely take a look. You're going to see in the textbook what is transaction. Fill that out. But that's step 1. What is a transaction? I then like to think on step 2, what accounts are being affected? So if hypothetically you were to pay a plumber for a $500 to repair a toilet, you would think, okay, so what accounts? Well, first off, how are you paying? Well, you're paying cash. So you know that cash is going to be one of the accounts affected. Secondly, you start thinking, well, what is the plumber doing? Well, he's repairing something. So you might use the repairs expense or the maintenance expense. And now you know which accounts are being affected. So you always want to think, before you worry about the amount and debits, credits, what accounts are being, is it a transaction? Yes. Which accounts are being affected? Well, we've determined cash and repairs expense. I then like to think, are they going up or are they going down? So in this case, when you're paying cash to the plumber, do you have less cash than before you started or more cash? Well, you paid someone, so you have less cash. So your cash is going down. Now your repairs expense. Have you done more repairs? Yes, after this, today as opposed to yesterday, or have you done less? Well, you've done more repairs, so your repairs expense will go up. Now I like to think, well, what type of account is each one? So remember, there's 5 types of accounts. You know that cash, or you will know that cash is an asset. Repairs expense is an expense. So we've got an asset and an expense. So then you have to ask yourself, step 5. So step 1, is it a transaction? Step 2, what accounts are being used? Step 3, are they going up or down? Step 4, what type of accounts are they? Step 5, what is the normal balance of these accounts? Now your textbook will tell you the normal balance is either debit or credit for types of accounts, and it is what makes them go up. So the normal balance for both, and you're gonna look at this in your textbook and fill it out in your workbook. The normal balance for both is debit. A debit to the account makes cash go up, and a debit to expense makes repairs and maintenance expense go up. Any expense and any asset. So now, if we have a debit normal balance that makes it go up, the opposite would make it go down. So we know for both of those credit would make it go down. So now we can look at it and think, okay, cash is going down and debit would make an asset go up, but it's going down, so we're going to credit cash. And then the expenses are going up, the normal balance of an expense is going to be a debit, so we're going to debit repairs expense. And then finally, the sixth step is, does it balance? So what we can do is do that transaction. So we said that our repairs expense is going to be debited and cash is going to be credited. And we can type in to pay the plumber to fix the toilet for our explanation. So again, first, is it a transaction? What accounts are being affected? Are they going up or down? What type of accounts are they? What is the normal balance of the account? And does it balance? So you can see here that it does balance. We have 500 on each side. Now, one thing I always have students have a difficult time to understand is that you don't need an up and down to balance at this stage, but you do need a debit and credit. For instance, if we didn't pay cash, if we paid accounts payable, which means that we are going to pay that bill later, then this is a liability. We actually owe more than we did before. So our liability has gone up and our expenses has gone up. So you don't need an up and a down, but you do need debit and credit. Okay, so that is what you're going to be doing for chapter 2. You're going to have to fill out the rest of your workbook, and you're going to have to read the textbook to kind of get you up to speed on the 5 different types of accounts and what they mean, what they are, examples. And then you'll have several dozen examples of journal entries that you'll be expected to do. Now let's talk about the trial exam.